It's a brand new week in the market and there are a lot of moving parts, many of which could affect your retirement. So I want to take a look at how we can grow and protect your wealth. This week we're going to talk about the Goldilocks market, or is it a Little Red Riding Hood market? We're also going to play a game of which would you rather, looking at two different stocks that are trading in very different ways, even though they operate in the same area of the market. And then if you're going to gamble, where's the best place to actually place your bets? There's a lot of gambling going on in the market right now, and I want to make sure that you're staying out of the dangerous places. And if you want to be speculative, there's some great opportunities for that. But before we get into that, let's take a quick look at some of the things that really matter in life. After all, that's what building our wealth is all about. Here at the Shite House, we kicked off our weekend by heading over to my parents' house and spending a little multi-generation time at their pool, enjoying the time together. So we had snacks. We enjoyed the beautiful weather. My son actually learned to dive off the diving board. This was his first time, and he was so proud of himself. And we even got to spend some time with my grandpa, who is 100 years old, still doing great, sharing some of his stories from World War II and some of the funny stories just from him growing up. He's always been a jokester and always loved to laugh and make other people around him laugh. After that, the next day, I got to run an ultra marathon with my brother Derek. This was his first ultra marathon after doing his first marathon just a few weeks ago, and he finished well. It was exciting to experience that with him. And then the rest of the weekend was pretty much recovery. I'd love to know what you did this weekend, or really what matters to you. What are you building wealth for? What is important to you? Because after all, the reason we build our wealth and the reason we protect our wealth is so that we can really focus on the things that matter in life. So shoot me an email, askzach@stpaulresearch.com. Let me know what you're up to, what's important to you. And now let's dive into the things that are actually happening in the market today so that we can build and grow your wealth. One of the most important pieces of news that came out last week was the jobs report, which told us that the economy added more than 500,000 jobs last month. Now, that sounds like a big number on the surface, and it's definitely encouraging to see more people able to go back to work, but that number came in below expectations. And a lot of people are calling this a Goldilocks market because the number wasn't quite as strong as what people were expecting. And so the thought is that the Fed can use that as an excuse to wait to raise rates and to wait to taper their bond purchases, which helped keep long-term rates lower, simply because the economy isn't growing quite as fast, and so maybe that helps inflation to stay at bay. The problem is this is the wrong way to interpret that news. One of the problems that we've talked about several times in the past is that jobs are not coming back as fast as we would like to see, and it's not because the jobs aren't available. It's not because the economy is weak. It's actually because stimulus programs and generous unemployment insurance is making it more attractive for people to stay at home and collect those benefits than it is for them to go back to work. And that's a big problem in our overall economy. So because of this, we're seeing fewer people go back to work. We're seeing businesses have to pay more to entice people to go to work. And that means businesses actually have to charge more for the products and services they offer because their labor costs are higher. All of that is actually inflationary. It's not a Goldilocks market where it's not too hot, not too cold, and the Fed can actually back off and not have to worry about inflation so much. So pardon the dad storytelling direction here, but instead of calling it a Goldilocks market that's not too hot and not too cold, I think of this as more of a Little Red Riding Hood market where something seems to be sanguine, something seems to be safe, like the wolf, when actually when you get close enough and start to understand what's really going on, there's a lot of danger involved. So I think that we need to be careful not to read too much into this weak jobs report and think that it means that inflation is at bay, because it's actually a sign that inflation could pick up much more quickly because businesses are having to work really hard and pay a lot to get workers to come in the door. So just be careful because we could see this whole narrative start to reverse. Second thing that I want to talk about today is a which would you rather type of a trade. Often in the market we see stocks that are trading sharply higher and other stocks that are trading sharply lower, and it's kind of confusing sometimes to figure out what's going on behind these two different trends and what's driving them. For years we've seen Tesla move sharply higher as people got really excited about the company's great products, about the dynamic innovation with electric vehicles, and the stock arguably went much higher than it should have just because there was so much excitement around Tesla. Now I know that's an argumentative point, and many people think that Tesla should be trading higher. But if you look at what the company's earning, and even what they're projected to earn in the next year, 2 years, 3 years out, compared to what the actual company is worth based on the stock price, Tesla is trading at a very expensive price. Meanwhile, the legacy automakers like Ford and GM are trading at a very deep discount to the level of earnings that they're capable of generating. So right now we're starting to see a switch in that. We're starting to see investors actually ditch the Tesla trade, and that's why shares of Tesla have been moving lower. Meanwhile, companies or investors are actually embracing the idea of some of these legacy automakers, and Ford has been moving sharply higher. There are a few reasons for this. One is that Ford is actually stepping into the electric vehicle game in a big way. They're investing billions of dollars. They've got their Ford Mustang that's now an electric version is available, and that's exciting. And they've also now got plans to launch the F-150 and to make it widely available as an electric vehicle. So while they may not be making the same level of quality that Tesla is with their cars, they are making electric vehicles available to the general public. And that's something that is helping to drive excitement in Ford higher and kind of taking a little bit of the shine off Tesla, just because Tesla's not the only game in town now when it comes to quality electric vehicles. As an investor, I think that we need to be looking at what's working right now, and I'd much rather be invested in a stock like Ford that you can buy at a discount price. Even though it's been trading sharply higher for the last few weeks, it's still at a deep discount compared to what you're paying for Tesla when you factor in what the earnings both of these companies are generating. Meanwhile, Ford should reinstate its dividends sometime this year. So once profitability kind of comes back to normal following the coronavirus crisis, we could get paid a very nice dividend to own shares of Ford. Whereas with Tesla, you're actually looking much farther down the road before you get paid anything for owning those shares. So this is a which would you rather, and at this point I would say it makes a whole lot more sense to invest in a stock like Ford that's trading higher, that has the potential to pay you a dividend, and that you can buy for a cheap price compared to the earnings that it generates. Finally, the most exciting area of the market, or the most dangerous area of the market, depending on your perspective, are these meme stocks, and in particular a lot of stocks that have been shorted by the broad market, stocks that basically institutional investors are betting will go down. Those stocks have been very popular with retail traders. The Reddit crowd, which is just a social media group of traders who are looking for these particular stocks that are shorted by the institutions, this whole crowd has been buying these stocks hand over fist in an attempt to kind of put the pressure on and hurt some of these institutional traders like hedge funds and other managers that have been betting on these stocks trading lower. This is very much a game type of a situation where these investors are doing something for reasons other than just making money. They're largely doing it because they want to hurt the hedge fund managers, and they feel like these managers have manipulated the stocks in the past, and so they're now going to manipulate them in a different direction. That may or may not work out well for them, but I can tell you over time, stocks eventually trade at levels that match the level of earnings that these companies generate. And right now, a lot of these stocks are shorted by the institutions because they're not generating earnings, because they're not good companies. So if you want to gamble, this is one of those areas where a lot of people are gambling. They're putting their money on. They're probably not going to make money over the long term, but it's kind of a fun thing to do. I've never really been a fan of casinos, but I think you might actually have more fun going somewhere and gambling at a casino and then going out to dinner and seeing a show rather than putting your money into some of these, they call them meme stocks, or some of these heavily shorted stocks. It's a dangerous area of the market, and I would definitely encourage you to either stay away from it or wait until these stocks pull back to much more reasonable levels. There's a lot of activity, a lot of risk, and so just if you're going to travel in that area of the market, make sure that you use small amounts, that you don't put money into it that you can't afford to lose, because there's just a lot of fast movement and it's hard to get out of the way. Meanwhile, there are so many great areas to invest and stocks that are generating earnings and stocks that are playing off of the economic reopening following the coronavirus crisis, and many ways that you can reliably make money and grow your wealth so that you can focus on the things that matter. That's what we're focused on here at the Rich Retirement Letter. I hope you'll stay with us throughout the week, and I look forward to hearing from you. Please do send me an email. Let me know how you're doing. It is richretirementfeedback@stpaulresearch.com. I read every email that comes in there, and I can't wait to hear from you. Have a great week.